the main thing I wanted to talk about today was the yield curve. So I'm showing you two yield curves here. One is the blue line from early January 2008. Many of you know what happened during that time, where there was a collapse in the mortgage sector, and then it spilled over into the stock market and then into the economy and what they call the Great Recession. So essentially, what brings on a recession is what's called an inverted yield curve, which means you've got short-term rates higher than long-term rates. So notice back in '08, the blue line, that didn't happen. You've got long-term rates higher than short-term rates, which is what's called a normal yield curve. But we still went into a recession, which some can argue was actually a depression. But look at what we stand today, August 4th, 2023, the red line, low short-term rates, these are the 1 and 2 month Treasury bill, are higher, 5.54 1 month, 2 month 5.51, are higher than long-term rates. See, you're paid to go short-term now, 3-month rates, 4-month rates. So you're actually paid a higher interest rate on a short-term investment than you are a long-term investment. So you can see, you go out 30 years, the rate's only 4.21. So what that means is no one is incentivized to buy longer-term Treasury notes. Or bonds, right? A note is less than 10 years, and then you go out into the bond market, and those are longer term instruments. So the rates are higher staying short term. This is never positive for the economy. This and historically has led to a recession. So I just want to bring this to your awareness because I'm starting to track this a little more closely. When I start to see recession indicators like this, where we look at the yield curve, you get paid to stay closer, shorter term, and little or no incentive to go out long term, right? You would never buy a 30-year bond paying you a coupon of 4.21 when you can buy a 1 month CD or Treasury bill paying 5.54, right? That's 120 basis points more than the long-term instrument. Short-term instruments tend to be less volatile. Long-term tends to be more volatile. So you're looking at safety on the short end of the yield curve. So if you're an investor, maybe you're rolling over a GIC or a CD, you'd want to stay with the very short-term duration, which is 1 or 2 months, or 3 maybe max. But you certainly don't get paid to go out anything past 6 months. 6 months is 5.5%. And then the year is 5.33. See how the interest rate drops off. So we have to be really cautious as an investor when we start to see this much of a sloping or inverted yield curve. We want to see a more nominal or normal yield curve, which is short-term rates are lower than long-term rates. We don't have that at all right now. We've only got an inverted. It's been that way for a while. And, ideally we want to see a much more normal curve. Hopefully that'll normalize over time. We'll see.